post on the YouTube. So thank you for like so today we kind of change our route slightly because Decorus and me were talking about the Excel assignment in the second homework of chapter 2. And this one, I think is nice for us to practice the different formulas and using the Excel directly. We talked about in the beginning why you see we incorporate Excel data analytics in the course, because in these days when you go to work, like any working place, and even you operate in your own business and looking for entrepreneurship, the Excel will help you a lot to work on the data more easily and save time and generate good results for you to make decisions. So chapter 6, overall, we are looking for CVP relationships, right? So the cost, volume, and the profit analysis. And the analysis is fundamentally based upon our understanding of the contribution margin income statement, which I already talked about in the prior 2 days. If you still need more help, like understand better, check the video recordings from Tuesday and Wednesday. And like this one, let's especially focus on this Excel application. So similar to the first Excel, we work, remember, in chapter 2, right? So in chapter 2, we worked Excel on job order costing system, but this is a CVP analysis. So assume, okay, I'm the CFO or like the accountant or the manager of the company. I want to do a few analysis to understand the operation of my company in terms of the what's my break-even points. And if I want to achieve a certain level of profit, right? So what level of sales volume I need to reach given the current pricing and cost informations, and how safely I'm operating beyond my break even. Okay, that's kind of the concept is trying to help us understand like break even calculations, target profit, or even the margin of safeties. So in the first part, you see the data. So this is the one I downloaded from my version. So I don't know, do you have the same number? I think most likely you have the same number as me, but this is the background information. And then you can revise, okay, again, so for example, if I'm operating my own companies, I can revise these numbers to accommodate to my setting. For example, okay, I'm using a different unit. I make up my own units, or I make up a question. Then what's your sales price, right? And here, so we are doing a simple one. We are assuming we have a single product. All service, okay, like the queries you were talking about, you are like a personal styling, right? That's a kind of service. You also can adjust it to like the service, okay, like per service, per client, how much I charge per service depending on the situations, or how much of my like the volume, how many clients coming, right? So that will be a volume adjustment. And then my cost to provide the service or make the product. Variable expense only, because contribution margin, we break down the cost into the variable and fixed based upon the cost behavior. So to provide this service, what is my variable expenses? So you can think about, okay, like for a manufacturer, again, we have direct material, direct labor, and variable manufacture overhead. But if you provide a service, so the query is can you offer something? So what might be the variable expense for your styling service?
I guess like maybe gas or something. I don't.
Yeah, no problem. Yeah.
Would that be like considered? like travel expenses.
Travel expense.
Yeah.
So travel expense, does it like related to the like the revenue?
Yeah, because I have to travel to my clients. So like
Oh, I see. That's definitely variable because I'm assuming the more clients you have, like the more revenue we are looking for, you have more travel expenses, right?
yeah.
Yes. And also, have you thought about your own labor? Right? Like I have a 2-hour service per client, right? So your
Um,
I know you have your so how about if you hire another like employee to do the job, you have to pay the like maybe the hourly wage or something, right?
oh, yeah, like an assistant or something.
Right, yeah, that
Yeah.
will be your labor, direct labor cost. You have your then just to pick up this too, right? And do you have any like fixed expense? Fixed, like uh like uh like something I must pay every month for me to.
Um, yeah, like like the services I use to like create invoices or something like that, like the
That's
program I
right.
use.
Your system, right? So you pay the fee for a invoice system, right? Like, so you
Mm-hmm.
you probably have a fixed charge, right? Like fixed fee charge. So that's
Yeah.
definitely, yeah, we are looking for here. So if you try to accommodate, okay, that's my charge, for example, per client per time, right? I don't like your charge.
Mm-hmm.
Then per client per time was my variable expense, like you said, my labor cost, my travel expenses. But I know the travel, we need to break down more details, right? So into this, and then my fixed, like my total fixed expense per month to using the invoice system or maybe business insurance or anything else, right? So that's like the same thing. And how many clients, like service time I'm expecting, like, for each period. So you can really, plug in this. So CVP is something you can immediately apply if you have a family business, personal business, or a small business. So because I also teach my MBA, like Master of Business Administrations, I have lots of students, they have their own business and they see immediately use for the knowledge they are learning from here. Okay, even roughly, they start to understand their operations better, from here. So that's background information. Then we'll plug it into different, the following requirements. So, but for us, the first part, contribution margin ratio and variable expense ratio. But for us to do this, okay, let me remind you, like think about the formula. Okay, I'm putting here because this is based upon our understanding of the contribution margin income statement. Okay, let me quickly develop this. Oh, I maybe have a typo here. Yeah, change this to text. That's your CM and minus expense, then net operating income. Okay, I just put income. So this is quickly, you can see I don't have any formula. I didn't try to memorize, but this is kind of coming from my mind. Okay, as a management major, doesn't matter any major, you should have this structure in your mind because this is really the way an internal user to analyze the performance of your business. So sales revenue minus all of your variable costs. So this is your contribution margin. And now you can see I can plug in. Okay, I will plug in the numbers here. So if I do the ratio or like the variable, so I will plug in the number. So if I do the units, okay, this is 60 per unit, right? Variable expense, 45. So that's then how much contribution margin I'm left over here per service minus, right? So this is the formula I will do is 60 minus variable cost 15. Okay, I'm easily will transfer to the answer part. Okay, but this is like my explanation for the workout. So contribution margin is 15. And then if I do the ratio percentage, the sales revenue will be my reference 100, like the whole chart of the pie. And then this the variable expense percentage. The formula you see, I will convert it to a percentage. Okay, 45 divided by 60. So, oh, I think data is right. No, I think I put it this wrong. Is F3. Yeah. So 45 divided by 30. Oh, wait, 75. So 2/3. Oh, sorry, 3/4, 3/4 of your revenue cover the variable expense. Like think about, I charge my client $100, right? But 75 is my variable expense. And then the rest will be your contribution margin. So you can use 1 minus the variable expense ratio, get the 25%, or you use the 15 divided by the 60, the same thing. Okay, so these two ways to work out the CM ratio is equivalent to each other. So this is on per unit basis. Make sense? And that we can easily transfer the calculation to here, but here is like my workout procedure. Question? Make sense?
Yeah, it's starting to make sense.
Yeah. So
Let's
yeah, I don't know. So just let me know. Okay, like just let me know if you like. Oh, I said like slow down. You know, I just one more time. Okay, let me know. So now I can transfer to here, right? And now this is my like the final. So selling price per unit, but I'm using reference. Okay, again referencing the here. Okay, like 60, and then the variable expense per unit, 45, and contribution margin ratio. And if I do the direct calculation will be this. Okay, I'm putting the formula because I use the sales revenue minus the, so B3 minus B14, then divided by B13. Again, revenue minus variable expense, then divided by the variable, by the revenue again. Sorry. I'm completely reading it wrong. Okay, so only the contribution margin, yeah, per unit. I made it more hard. I thought about the ratio already. Yeah, that's exactly what we talk about. So B14, 25, 15. Yeah, so $15. And then basically the one I'm going to see the 75% and 25%, right? So now doing here, the CM ratio will be 15 divided by 60. And the variable expense will be 1 minus the 25, or I use 45 divided by 60. Use referencing to the sales we set up. So that's a better way. So what's a better way for using referencing? Because when you're planning your operations, I may change the dimensions, right? The dynamics. So I may say, oh, I may not be able to charge $60 to my customer. How about if I only can charge 50? Right. So rather than I'm like using a, I have a column for 60, 50, I can easily So if you don't have a referencing, every time I'm typing the 60 or 50, every time I change the number, I manually update all of the calculations. But yeah, if I have the referencing, if I change the pricing, all of the remaining calculations will update accordingly. Okay, that's the power and useful for referencing the sales. Okay, my baseline information, I can change the factors here. It will be reflected in all of the answers or like the the results, the outcome. Okay, so we can easily. I'm going back to the $60 again. And that's when you do the homework. The question was asking you, oh, change this cell, you should see this answer. That's a proof you have done the job correctly. Because all of the formula right, I can just change the numbers, right? So different combination, that's your CVP analysis. So I'm playing with the numbers for different options to see what's the optimized. So what's the best combination for the factors for my business. So far, the basic line. No problem. Right. So if you have question, just stop me. Oh, I have one more. I have a question.
Okay.
Yes,
So
no,
on the,
Taji. Yeah, okay. I'm working on. So how about after I finish this, we can get back to your question?
okay.
Okay. So quickly, then first, that's the fundamentals, right? That's the fundamentals of my income statement. And now, compute the break even. So what's the break even formula? Probably you already know. Okay, let me like speed up a little bit. Break even in unit of sales. I'm just saying it verbally. Okay, fixed expense divided by unit, like a unit contribution margin. Okay, I can quickly put it here. Fixed cost divided by unit CM. Okay, you probably can tell like what's my letters. Fixed cost, unit contribution margin. Then I just plug in. I already have those numbers in my background. So break even point, my total expense, fixed expense, 240,000. I'm referencing to here, and then divide by the unit contribution margin I have from my prior calculation, 16,000 units. Break even, no profit, no loss, my benchmark. And currently, maybe I'm selling or I'm planning to sell 20,000 units, right? So that's benchmarking. And then break even in sales dollars. So how I can do this? And if you're looking for the formula, it will be the contribution margin ratio, right? That's like the formula. And I don't have the contribution margin ratio. Oh, we do have here. Okay, like, so this one, same thing. Fixed expense divide by the ratio. And even they already have the currency sum for us, right? 16,000 units and then $160,000 for break even. Okay, that's this part. Break even means, you know what I mean, right? So no, like how many clients I need to serve for each month to break even. And then margin of safety, that means your current, how safely I'm away or far, right? You know, above my break even. And we can easily tell 20,000 minus 16,000, right? So units or in dollars. Because right now I don't have my, for break even margin of safety in dollars, we already have the dollar of the break even, but I don't have the current sales, but I can calculate. Okay, so margin of safety equals to, I put the formula here. Okay, the current sales minus the BE sales, break even sales. So current sales, again, I'm directly doing the calculation, units multiply by the pricing, right? So that's my current sales. But I need to minus the break-even point. Okay, I'm holding on a second, looking for the formula. Equal 240. So I'm safe above the break-even by $240, $40,000. And then the percentage will be your margin of $15 divided by my sales revenue again. Okay, I probably need to calculate here again. Let me put a parenthesis. 20 times. I should probably have a row for, again, seeing the formula. Okay, so this is a percentage. Okay, so in dollars, the dollar safe, okay, divided by the sales revenue. Oh, so did I put it here? Yeah, quickly. So the margin of safety in dollar then divided by, so 20%, not too high. Okay, is acceptable, is like the lower limit of your acceptance like level. Okay, so if it's drop additionally is is very hard. Okay, like it's very easy to like drop to loss. Okay, so it's not a very safe. Kind of on the lower bound of the acceptable level. Operating leverage. Operating leverage is the way we try to see how fast the profit will react to the change. So what's the purpose of operating leverage? So we are going to see how the net income change in reacting to the sales change. Did you see I'm putting an explanation here? Is my own definition. Okay, I'm not copying or memorizing from the book, but this is what the concept means. So when I change, for example, 5% of my sales revenue, right? Then how large the change of my net income? Larger than the sales or smaller? Most of the times it will be large, but how large it will be? Because we want the leverage to be large when the sales are strong, right? A small sales change will increase the profit a lot in good times. But in the bad times, like the COVID section, right? The COVID, like those attack, a small sales drop will hit hard on my bottom line, the profit. So operating leverage, I normally say is a double-edged sword. Makes sense, double-edged sword. Good times, good. Bad times even can make it worse. So you need to really manage this very sensitively. Okay, so and now let's see the and this is basically your net income statement. A net income statement under the contribution margin is really like what I'm working here. Okay, I like it. The question have it in the bottom for us to figure out the operating leverage, because the operating leverage, the formula itself is contribution margin divided by net income. So we need to know the contribution margin total and net income to calculate this. And now we can work on, so sales revenue, we already did it. Okay, I believe is 1.2 million. Sales price per unit, I'm using the top. This one is fun also. So equals to unit times pricing. Okay, 1.2 million. And then the contribution, variable expense, unit times the variable expense per unit, right? So 900. And contribution margin, the difference between these two, 300,000. then minus the total fixed expense. The sum, they already put it here, okay, right? So 240 is already a deduction. So when you calculate the net operating income, be careful. Okay, this one should be, because they already put it in minus sign, I should plus, okay, like B30. Oh, sorry, 32, okay, this. $60,000 net income. Okay, so eventually we earned a 1.2 million revenue with a contribution margin 300 and eventually 60,000 net income. Then my contribution, operating leverage contribution margin divided by 5. Leverage, okay, like means the VEG. Okay. So in another way, so what this 5 means, if my sales change, I would say because the change can be both directions, change 1%, income will change 5. The leverage multiply by the percent, it will be, so what is the means? Okay, why we use this? Without any calculation, you can say for sure, my net income will react by 5%. So the leverage power is 5. Okay, and some company have higher leverage and some company have lower leverage. If you have a lot of fixed expense, your leverage ratio will be high, like the energy companies, because they have lots of fixed assets investment. And if I have a relative high variable expense, like the merchandisers, retailers, or even like, the services, right? So most of my expenses are variable, then you have a low operating leverage. So the operating leverage is kind of a way reflecting your cost structure in terms of the variable and fixed cost. Okay, I can put an explanation. So if you have high fixed cost, the operating leverage will be high as well. Like I'm saying, the energy or heavy equipment, and then low fixed cost, or I can say like high variable expense. Okay, then you probably have a lower operating leverage, and that's like a service. And what I say, maybe like high tax services or retailers. So that's give the managers a idea when you change your portion of your expense, right? So like, for example, if you need more laborers in the holiday seasons, so what the companies normally do, like the retailers, if they need more laborers in the holiday seasons, they hire part-time job, right? They have like a high season laborers, but they are not hiring permanent staff, because the decision you hire a part-time job, like you offer hourly wage or you give a permanent offer, will change your variable and fixed cost portion, and then will change your operating leverage in the future. And we don't need a permanent labor for all of the, the time. So we can just use, because part-time job is like an hourly rate variable, right? But if I have a permanent worker, that's on my payroll, right? On longer time is fixed expense. I think that's kind of, any other questions I can answer from here? So Decoris, do you think you are better, you can handle this after this review?
Yes, I'm gonna go through and practice a little
Okay.
more myself, but
Mhm.
you broke it down a little bit more. Tell me.
Okay. Yeah,